Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and joining me this morning is David Chiaverini, Managing Director and Equity Research Analyst at Wedbush Securities. Welcome to the show. Great to have you, David.
Thank you. Great to be here.
Well, just earlier this morning, President-elect Donald Trump was on the floor to ring the bell, and there was absolutely boisterous, loud applause for him, chants of USA, as you might imagine. So, with his election as the 47th president, how do you see this in terms of the outlook for the the economy and the implication for banks?
Yeah, so I view it positively. The big kind of theme out there is deregulation, and deregulation should enable M&A to go through faster, less red tape to get things done. Tax policy ought to be more favorable for businesses. So really the pro-business agenda of the president-elect is likely to lead to a stronger economy. And for banks, that could lead to lower credit costs because borrowers will likely be in a better financial position, both on the commercial side as well as the consumer side. And one of the things that could also be a catalyst here post-election is loan growth. Loan demand for banks has been weak, but now that we have more certainty and deregulation and potentially more M&A opportunity, that could lead to increased loan demand. The other issue that is not related to the election but could also help with loan demand is lower interest rates. Since interest rates have been, higher for longer for quite some time, that's led to lower loan demand. But as rates come down and the cost of capital comes down, that could encourage more loan growth for these borrowers to take on as their projects pencil out to more and higher IRRs to achieve getting over those hurdle rates. I'm expecting loan growth to pick up. The other thing that should be nice is deposit growth and being able to fund that loan growth. As that's put to work, we should see average earning asset growth and lead to earnings growth. So overall, I'd say that I feel more constructive on banks now than I have in 2.5 years, ever since the Fed started raising interest rates in the spring of 2022. So I'm feeling constructive here.
That's really encouraging because given this phenomenal year that stocks have had overall, there is some concern that can we repeat that, or can we have a great year in 2025? Are expectations too high? How fast? You mentioned deregulation. How fast do you think this deregulation? Will we see that in the first quarter? Will it take into the middle of the year? How quickly will we see the impact of deregulation?
Yeah, it could take time. Trump will likely do his best to speed through as quickly as possible many of the items. I think he wants to, pretty much scrap, 2 regulations for every one, or maybe even go 10 to 1 of scrapping regulations for every one that's implemented. In terms of the timing, I think it could take several quarters for it to come through. I don't think you can really flip a switch and the deregulation comes through. But what's important here is the sentiment and the mindset of business leaders. Business leaders will look at this and say, okay, we have a 4-year kind of runway, and that if the deregulation doesn't come through in the very first few months, it is likely to come through. So, for instance, for bank M&A during the Biden administration, the typical length of time for deals to get approved historically has been more like 6 to 12 months for a bank deal to be approved, but under the Biden administration, it's been more like 12 to 18 months, so it's been extended. So now when deals get announced, they are likely to get approved much quicker than they otherwise would have. And then the Justice Department is likely, and the FTC is likely to, bring up less criticism of deals as they come forth. So I do expect deals to come through in the deregulation aspect to come through over multiple quarters, but I don't think it's going to be multiple years.
That's a great point. You'd see Andrew Ferguson replacing Lena Khan at the FTC. I think a lot of people are pretty happy about that. And so do you expect are there any, sort of large or maybe even regional banks that have been bandied around as, could be buyers or being purchased in terms of over the next year or two, now that it won't take forever and there won't be roadblocks thrown up every step of the way?
Yeah, there are a few top of mind. I would say Comerica, ticker is CMA. I think they could be a takeout candidate. And one of the issues in the bank world is becoming a Category 4 bank, which basically means when your assets go over $100 billion, you are subject to increased scrutiny from the regulators. And that comes with increased expenses related to compliance, related to liquidity coverage, so on and so forth. With Comerica being just under 100 billion and call it the mid 80s of billions, on an organic basis, they could be going over it, within the next few years for that matter. So they could be, and there's a mindset that companies would rather achieve scale to spread out those costs over a bigger asset base. And M&A could make sense for a company like Comerica being at 85 billion. Another company that kind of falls in that similar category is First Horizon. That ticker is FHN. They previously were acquired or announced an agreement to be acquired by TD Bank up in Canada, but the regulators ended up blocking that deal due to BSA AML issues with TD. But it shows that First Horizon was a willing seller then, and given the deregulation and them being similarly in the 80 plus billion of assets, they could be a likely takeout candidate. A couple mid-sized banks that aren't bumping up against the 100 billion threshold. Wintrust, WTFC. They're based just outside of Chicago. They basically are the largest independent bank serving Chicago. I think they could be a takeout candidate. Another one that I could float out there is Webster Financial, WBS. They are in the 80 plus billion kind of size range. So I think that they could be a takeout candidate. And their valuation is very low compared to other banks on a PE basis. So I would expect Webster could potentially be a takeout candidate. And then the last one I'll mention is Bank United, BKU. They're based down in Florida. That's a franchise that I've been expecting to be sold for, a few years now, but I think with the deregulatory kind of backdrop, I think they could be on the docket to be sold.
Those are great names for investors to look at, especially if you're a little bit concerned about just buying the blob of the S&P 500. And with the new administration, certainly, sounds like it's likely to give an impetus to some of these deals that we haven't seen before. I want to move to a little bit to interest rate expectations. And I get the Fed meeting next week. The 25 basis point cut it's 98% priced in. And barring any surprises from the Wall Street Journal, that looks like it's likely to happen. But I suppose the market will be looking at the dot plot, so to speak, and see what the policymakers have penciled in for the end of 2025. So how sensitive are the banks to whether it's the 100 basis points of cuts that are priced in that were priced in September or forecast in September versus what if it's down to 50 or 75 with the new dot plot on Wednesday? Is that going to mean a lot for the banks?
Yeah, so I think it will have important implications for the banks. And I, too, am expecting 25 basis points with the next meeting and 100 basis points over the next year. I think it's a reasonable assumption. What's important is the shape of the yield curve. If the 10-year Treasury yield stays kind of static in the same neighborhood that it's at today, and then the front end of the curve comes down and we get that steepening, that is very favorable for banks. And then to the extent that we do get less cuts than 100 basis points over the next year, that too, I think, would be incrementally positive for banks because in general, most banks are asset sensitive and benefit from higher interest rates. So it really, there's a few things that, are dependent and kind of X factors when it comes to interest rates. But at the end of the day, they truly are important factors that impact bank net interest margins.
Could you just actually explain a little bit? You said just before that the banks are asset sensitive and work better with high interest rates. Could you just explain that a little bit for the viewers?
Sure. Yeah. So asset sensitive basically means their assets, so their loans and securities, will reprice faster than their liabilities. So as interest rates go up, their loan yields will move up faster than their liabilities like deposits and borrowings. So that will lead to their net interest spread or their net interest margin expanding in that environment.
That's a great insight because you hear that and sometimes you just don't actually understand why that's happening. So they want rates to not drop too low, just enough to get the economy going, but to keep their sort of assets to be repriced properly.
Yeah, I think that's a fair way to see. That's a fair way to describe it.
I want to get your ideas on some potential risks ahead in the next couple of quarters that in sort of this post-election, at least financial markets exuberance, that investors should be wary of, that they might not immediately see.
Yeah, so the risks would be to, now granted, there's a push and pull in that if rates stay higher, you get the benefit of fixed asset repricing on the asset side. But then you also have the concern on credit quality. The other thing I'll mention about, the yield curve and shape of the yield curve and interest rates coming down, one of the kind of offsets or benefits of lower rates for banks is their deposit costs. As interest rates come down, banks will be able to reduce the offered rates on their deposits, whether it's CDs or money market accounts. So that should help the net interest margins. But the reason why, and you getting back to the key risk over the next few quarters, is if interest rates do stay elevated, and if that were to be the case, it could be driven by, tariffs. That could put incremental pressure on borrowers because the cost of their debt would be, higher, and it could lead to stress on that borrower, and could lead to, less borrowings over the next, several quarters because of the higher rates that are being offered on those loans. So I would say credit quality could be one of the risks if rates stay elevated. But at the same time, hopefully rates would be elevated because the economy is doing well, because the health of those borrowers are doing well. But that would be one of the things that, we'll have to see how it progresses and some of the reasoning behind if rates are higher.
Well, thank you so much for that insight, and I would love to have you back on the show again when your timing permits. Thank you so much, and have a wonderful holiday.
Yeah, my pleasure. Thanks for having me on. Happy holidays to you.
And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sompro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thank you so much for joining us. We'll be back here tomorrow. Have a great day.